Yep.
Hey there, Bill. How's it going?
It's going great, Kev. Welcome into the Investor Guys podcast. Kevin Mills, Bill Barnett here. Your real estate guys, Kevin and I, we got started late today because he and I have been enjoying some political conversation, which doesn't have anything to do with real estate.
Yes.
So what do you think we ought to talk about today in real estate?
You know what? You were telling me while we were off air, and we're laughing actually because we've had a whole long conversation now for about half an hour without you guys. But we were talking off the air about your new project that you've got that you're waiting on your paperwork for right now. And it brought up some good points regarding evaluation. And today, let's talk about evaluating properties. And let's start off with your property, because that's really what gave us the idea of discussing this today. So let's hear about your property, and let's talk about the evaluation that you've done on it and what your tentative plans are for the property, so that we can set a sort of foundation for this. And then we'll move into different types of properties.
It is way out in the county, and I am in Tarrant County, which is Fort Worth, Texas, way out in the county. And it is when the price stopped me in my tracks. I paid $25,300 for it. And it has a structure on it. And I went out and looked at the structure. The structure is, I'll just lovingly say, it's a mess. It has a on it that's probably 20 years old. It's about 2,000 feet. But mobile homes have a very different, and Kev, you're familiar with this, mobile homes have a very different rehab process and a very different rehab cost than it does when you're doing a stick build. And so this is a property that I can probably completely rehab in the 10 to 12 range. So I'm going to be in this for under 40. It'll bring somewhere in the $1,000 to $1,200 a month range if I go Section 8, and I'm going to with a Section 8 tenant. But one of the things I love about it is it's a half-acre lot. And the way the lot is situated and the way this unit is on the lot, I think probably what originally the owners might have had in mind was that they were going to build a stick built on the lot. And so this is situated on one side of the lot, meaning that I can go in and split the lot and have two units on it and have it go with the county to get it set up that way so it can be redeeded, have it replatted that way. That should not be a big issue at all because of where it is. It's not in a subdivision. It is out in the woods. There are no deed restrictions with the deed. So replatting it for two as opposed to one should not be an issue at all. And with that, now I can go in and bring in a used unit. And a used unit, you can buy, a lot of times you can find good used units in the 10 to 20 range very easily when you're paying cash. And it's not going to be in the Taj Mahal range, but it makes the evaluation process pretty easy. So when we start looking at how do I evaluate a property? So I want to see what cash flow is on the property. Anytime you're buying a property, whether you're buying a flip or whether you're buying a buy and hold and a rental property or a seller finance property, and that's another exit strategy that could be used on this property is doing seller finance. But anytime you buy a property, you look at what's the cash flow on it. Every property that you buy, if you're purchasing it correctly, my dad, Kevin, certainly say this 1,000 times. My dad always taught me, you can sell anything if you buy it right. And so if we're buying it right, then we can turn around and look at, I have multiple options on this property. Yes, I can turn around and flip it. Actually, if I'm buying it truly correctly, I probably have enough room that I could even wholesale it if I wanted to. Certainly could this property. Then I could turn around and just flip it. I could turn around and I could retail flip it to an end user, or I could wholesale flip it to an end user, which means I'm going to an end user and they are going to be doing a lot of the repair work, if not all. But that's a different wholesale price than wholesaling to another investor. So I've got three different options there on the wholesale side. I can go with rental and do it as a Section 8 or as a straight rental. That would depend, some of that would depend on what I end up doing in the rehab. If I'm doing a Section 8, I'm going to go a little more durable. If I'm doing it as a straight rental, I'm probably going to go a little more aesthetic. And then I can just do it as a flip. And if I'm going to go flip, I'm absolutely going to go with significantly higher aesthetic value on the rehab. But if you buy it right, you're going to have all of your options available to you. So you look at it, and certainly I think you should do all that before you make your purchase so that you know you're buying the right thing. But you look at it and go, here are my options. Now I got to look at, how am I paying for this? If I'm paying for it, if I'm using private money to do it, I've got a cost of funds, no matter where the money's coming from. I could put, a property like this one, you can literally put on a credit card. Well, that'd be pretty pricey, but it would still be cheaper than bringing a partner into the deal. But I can also look at doing hard money on it and doing a 12-month hard money loan. I could do private money on it, and private's typically always going to be cheaper because I got no points. I'm usually going to have a lower interest rate. But a lot of hard money right now, you can get longer terms than the 12 months. And so I look at what my cash flow is. How much have I got to come out of pocket for? And now when I've got my cash tied up in it, and look, if you're paying for it 100% out of your pocket, you have cost involved. And that cost is, what else could I be doing with that money? Opportunity cost. So that's the first thing we're doing, is we're looking at cash flow and helping evaluate which strategy we want to use on the property. I'm looking to build more and more passive income. And so I'm looking for using it as a rental, and I'm going to use this one as a Section 8 rental. We're going to talk more about other forms of valuation as soon as we come back for the break. So hang around with more Investor Guys podcast. We'll be right back.
11 months out of the year, Bill and I host real estate buyers events in cities like Cleveland, Ohio, where we ourselves invest and see great returns. We show investors the types of strategies we're using, the types of properties we're using. We introduce them to people here on the ground and the resources that they can use to get started right away. Day 4 of this event, we're actually touring properties and making offers on properties. This event was designed to put properties in your portfolio right away, high-performing properties. Read more about the Real Estate Buyers event. Get registered. We'll see you at the next event, realestatebuyersevent.com.
A lot of real estate training programs claim that they will make you a millionaire, but how many of them will guarantee it? The Millionaire Blueprint comes with a millionaire guarantee. I guarantee that if you use the strategies and you use the formulas that you learn in the Millionaire Blueprint, you will be a millionaire. I guarantee that with a double your money back guarantee. Whether you have hundreds of thousands of dollars to invest or absolutely nothing, it doesn't matter. I'm going to show you how to start investing and be a millionaire guaranteed. Now, I can't tell you all about it in this short amount of time, so go to theguaranteedmillionaireblueprint.com. That's theguaranteedmillionaireblueprint.com. Watch the videos there. Read about the guarantee. Read more about what we offer with the Millionaire Blueprint. Get signed up. I'll see you in Palm Beach.
And we're back, and just before the break, Bill was talking about a property that he just picked up, and I want to recap for those of you who were watching. Essentially, Bill saw this property. He noticed that it was on an extra large lot, and he was going to be able to, well, one of his possible strategies was to split the property. Now, one of the things that he had mentioned was bringing in another modular home, a mobile home. Now, he had also mentioned that he wasn't going to get a Taj Mahal version, and that is because the house that is already there is already at a certain level. He's not going to put something that's greater or something that's significantly lesser right next to the property, because it's going to affect his other property. Either way, it's going to affect the property he puts on there, or it's going to affect the unit that he has already. So he's going to put something that's very similar to what he has already there. Now, he already knows that this is a good deal. He's going to do the deal. Okay. He now has to figure out what is going to be my exit option. Now, his exit strategy isn't always necessarily getting out of the property. His exit strategy could be what he's considering strongly right now, which is renting the property out. And he's thinking Section 8 because it's a strong Section 8 area. So far, his evaluation has led him to, this is a lot that I probably want to split. This is a lot that I'm probably going to put another unit onto. This is a lot that I'm probably going to hold for cash flow. You had mentioned while we were off the air, when we were talking, you're going to get 900 to 1,000 more than likely on Section 8 for the unit that's there, which means you'd probably get 900 to 1,000 for the unit that isn't there yet. When you do the math, he's picking this up for $25,000. He's putting $10,000 into rehab, into the property. He's now got 2 lots in one structure for $35,000 that he's going to make as much as $1,000 a month on. And that's a cash flow of, you've done the math already. What's your percentage exactly?
So I think we'll be around the 73, 74% for expenses on it with cost of funds, insurance, taxes, everything. So we're going to be pulling out about 25%, maybe 26, 27%, but let's just go with 25. So to make the math easy, if you're saying that for both units combined, we're getting $1,000 each, $2,000 a month, $24,000 a year in gross revenue. And if I can pull in 25% of that as net profit, which certainly looks like where we would be, and that's a pre-personal income tax, but pre-tax profit of 25%, when you start looking at 25% of $24,000, that's $6,000 a year net. If I'm pulling in $6,000 a year net, and I'm going to have $10,000 of my money, that's it. Everything else is borrowed. If I've got $10,000 out of pocket and it's bringing me $6,000 return to me, then that's a 60% cash on cash return. So the first year, I will have 60% of my personal investment back. And the second year, I will now have all of that back, and I'll have 40% profit off of that 10. I'll have $4,000 or so that second year that is pure profit, all of my principal being returned. And from that period forward, so out of 6, that'll be a third of the, or 2/3 of the year. So we get to about this time, 2 years from now, that unit will, my cash will be completely out of that. And I'll be getting pure cash on cash return, 60% yearly from there on out. Nothing wrong with that. With nothing left, I won't have anything left in the property.
Now, one strategy that Bill hasn't mentioned yet that I actually like because it makes it easier. Before I go over the strategy, what do you think these 2 lots will be worth total with a second unit already in place, everything redone? What do you think the total value will be?
So think about this for a minute. So let's go 6 months down the road. We've got both units on the property, both units in excellent shape and inhabited, rented, they're rocking and rolling, and we're getting $1,000 a piece for them. So one of the ways that you have to evaluate this property then, and this is one of those other things that you look at when you're looking on the front end, is could I sell this as an income producing property? And look, you're going to have some people tell you, well, Bill, it's only 2 units, it's not 5, so it's not really commercial, but I have done it multiple times. And if I decide to, we'll be doing it again. I think I'm going to hold on to these, but I could turn around and sell this as an investment property with tenants in it, a cash flowing property. And so now you start looking at, you get what's referred to as your NOI, your net operating income. So we already know what that is, or what it should be, which is going to be about $6,000 a year. And when you do that, you start looking at, okay, right off the bat, without adjusting, doing anything to improve that number, that takes what will be about $35,000 and turns it into 60 in the blink of an eye. But by the time you get into that second year and your NOI goes up, then you start looking at, man, this really probably could pass the second year, start looking at $75,000, $85,000 if I wanted to sell it that way. I don't think I'm going to. I think this is probably one I'm going to hang on to for a while.
So actually, the direction I was going in was a little different than this.
Okay. Well, let's go.
You got me to where I went. You're thinking $75,000 to $80,000 for the value for both the properties. Okay. Now, your total investment is going to be less than $50,000 into this property, and that's if you took it. I think
it'll be 45 or less.
Right. That's if you took it out of your pocket. And that's if you wrote a check. And most people who have been investing even just a little bit, or most people even have access to, you know, $50,000 or $45,000 to where they could do this themselves. Quick and easy way to do this, in fact, would be pay cash for the whole deal.
Yep.
Then once everything is done, he can literally go to the bank and he can do a cash out refi, leaving 20% of his equity in the property, which he's already paid. He can get the rest of his cash that he's already spent out of the property, plus all the improvement equity that he's put into the property. So let's say he's put $45,000 into it. Let's say the property is worth 80. He's leaving 20% in there. So he's leaving, let's just use round numbers and say he leaves $20,000 in there instead of $16,000. So he's pulling out $40,000 roughly that he's putting back into his pocket. Am I wrong? Actually, it's more than 40. It's 60.
Yeah. But let's do this. We're at 8. Let's take a quick break here. We'll come back. We'll talk about how we could refinance that property and how you can pay for it, and what might make more sense from a dollar standpoint. Hang around with more Investor Guys podcast. We'll be right back.
See you in a minute.
My name's Kevin Mills. I have a real estate training program that is so powerful, I will back it up with a double your money back guarantee that it will make you a millionaire. That's right. Double your money back guarantee that you will be a millionaire if you use what you learn in the Millionaire Blueprint. I call it the Guaranteed Millionaire Blueprint, and you can read more about it and watch more videos at guaranteedmillionaireblueprint.com. That's guaranteedmillionaireblueprint.com. Check it out. All the information is there. Are you ready to start adding performing properties to your portfolio, high performing properties to your portfolio? If so, check out the Real Estate Buyers Event. Once a month, with the exception of December, Bill and I host a real estate buyers event in a high performing market where he and I are both investing. He and I both have experience. We share our experiences, our resources, what to buy, what not to buy, where not to buy, what strategies to use to get great returns on your investment in these markets. If you want to read more about it and you want to join us for one of these future real estate buyers events, go to realestatebuyerevent.com. That's realestatebuyerevent.com. We'll see you there.
And we are back with the Investor Guys podcast. And just before we went on our break, we were talking about another strategy, which is refinancing a property that you put your cash into. And a property like Bill has found where you can actually pay cash for pretty much everything that needs to be done. The acquisition of the property, the rehab of the property, the improvement of the property that's adjacent to it after you split it off. This is something that if you have the funds, instead of trying to add an extra facet to this, figuring out how you're going to bring somebody else into it as far as funding, lending, whatever else, if you have the funds, do it yourself and then cash out on the tail end, which is absolutely doable. It's a refinance, and refinances are easier to do than an initial finance for the property. So we had started that conversation just before we left, and Bill had some thoughts on that.
So if you look at value, once we have both the lots developed, both units owned there, the retail on that's going to be at least 80. So if in Texas, as it is in most parts of the country, you got a 20% equity that you leave in the property on a cash out refi. So be able to pull out $64,000 leave in 16,000 equity into the property, which gives you cushion. So I'm able to take that 60 back out of the property. Now I'm going to be in it, I believe, less than 45, but even if we go say, okay, full 45, that's everything, both units, everything. So there's $15,000 into the pocket right then. Everything has been returned, and I've got.
And that's not counting the equity that you left in the property.
Right. So
and
I
that's
got
not counting the control of the
$15,000
property that you still have.
Yep.
And that's not counting the income from the rents that you're going to have.
Yeah, which is we're about to.
Right.
So I got $15,000 cash in the pocket. Now that's net ahead. See, I've already paid back everything that went in on the front end. So I got $15,000 that's come out into, or 16 that's come out, or 15 that's come out into my hand because I'm leaving 16 in. So between the two, there's $31,000 right there. 16 remaining in the property as equity, 15 in hand. So I got $15,000 cash in hand. I'm still getting $1,000 a month gross on that. I'm still getting $6,000 a year net. So now you start looking at, I got $15,000 cash out of the deal. And then at the end of the year, there's another $6,000. So I got $21,000 I'm up after year one. What have I got out of pocket? A big old fat goose egg. If I've got nothing out of pocket and I've made $21,000 that first year, then what's my rate of return? Well, you can't calculate it. You've got no basis points to start with. So it is a great, great, great way to start looking at how you evaluate, which will help you change, or not change, but decide which way you want to go on your investment philosophy.
Yeah. And it really, the key is being able to think outside of the box. Don't listen to what somebody is telling you this property is good for. Think, what else could this property be good for? And we've talked about this on the show before, when an appraiser goes and looks at a property, they appraise the property. They could be looking at a residential property, but if it is sitting in a lot that is commercially zoned, they're appraising it for its highest and best use. Highest and best use for that residential property, because it's sitting on a commercial lot, is probably a commercial use. That means that the residential house that's next door or across the street that's sitting on a residential, an R zoned lot is going to appraise for less than that residential property that's sitting on a C lot. Now, you need to put the same kind of mentality into your head when you're going to look at these properties. What is the highest and best use for this property? And it may not be that you get it rezoned commercial. It could be, in Bill's case, split this off and do multiple properties. When we did the episode on farming a few days ago, I showed you guys a property that had already been subdivided into 4 different properties. I could put 4 different homes onto that property, or I could put one big giant home on that property. It has 4 different addresses. The address will be whichever one comes in for the utilities. What is my highest and best use going to be for that property if I get it? You need to do that evaluation for every single property that you get, and then run your numbers based upon that realistic expectation. Now, one of the conversations that Bill and I had, excuse me there for bumping the mic. One of the conversations Bill and I had before we went on the air was, is it going to be an area that's going to be easy to subdivide? Because just because you see a large lot, you might be in an area where they say, no, all the other houses around have large lots. We're not going to let you subdivide this. Or if we subdivide this, your lot lines are going to be too minimal, because you have to do a minimum of X square feet for a structure. So make sure that that's a viable option. Don't just look and say, oh, I'm going to subdivide this. Okay. Make sure that's a viable option to you. Don't base all your numbers on that unless you know that that is an option that you have. A lot of times investors like Bill and I, and Bill's already gone over the different options that he has on this property. We won't go into a property unless we have a backup. So what happens? We think we're going to be able to get a subdivide. What happens if something changes? Maybe they change a law or something in the time before we make this offer and we actually get the offer and we're ready to make this subdivision. Something has changed. What is going to be our backup strategy? Is our backup strategy still going to have good numbers? Does this still make us a good deal? Have a backup strategy, have a couple of backup strategies. Is that all part of your evaluation process when you go into looking at any property at all, whether you're looking at an apartment building, strip mall, a residential property, or vacant land? Have that strategy in mind. Look at what you're going to be doing with that property, with that land, with whatever acquisition is that you're going to be getting it for. Final words, Bill?
Yeah, it's all about just thinking through the process, understanding what your numbers mean. That's what Kevin and I teach is, the numbers inside out. If you know your numbers, when you look at a property and the numbers tell you this fits, whatever your investing strategy is, the numbers say this fits, then pull the trigger. Then say, hey, yeah, let's do this thing. And then you move forward. I can't tell you the last time because I can't remember the last time I bought a property this cheap. It just blows me away. But keep a lookout, see if I can find some more of them like this. But it's crazy.
You really almost can't not buy a property when you see it at that price.
Yeah. So, hey, thanks so much for being a part of our podcast today. We appreciate you guys being here and listening to us on the Investor Guys podcast. Hope you get some great knowledge and information, insight into the investing world out of it. If you've got any suggestions that you'd like for us to cover on a future show, please send us an email, kevin@investorguyspodcast.com or bill@investorguyspodcast.com. We will be more than happy to look at those, cover those. Got any questions whatsoever, throw them out there, and we'll look forward to having.
And we'd love to hear from you guys.
Yeah, we love it. Hey, thanks so much, brother. Enjoyed it. Another great podcast. Thank you for being here today.
Thank you.
And, see you Wednesday.
And we'll see you guys soon.